Gracious, I'm loud. Thank you. So I usually, give you the 55 slide presentation. I drill through the economics, I drill through the freight, and we decided that, since we already spent an hour and a half on the economy and we just had Tim spend 30 minutes on freight, there was no need for me to reprise everything so deeply. So this is kind of what I'm going to talk about. So I couldn't not have at least one economic slide and one freight slide. So you have to bear with me there. So we'll talk about the slowing economy and falling freight demand. Then talk about the rapid expansion of Class 8 supply, which Tim also touched on. And then the impact of that falling demand and that rising supply, and we really see it in the current market activity, and with that we'll do a little bit of Class 8 cycle analysis, which is history doesn't repeat itself, but it rhymes. Perfectly sums up where we are today. And then we'll review, look at the forecast and touch on some alternatives. So if anybody needs to leave in a hurry, this is really the one chart that you need to walk away with. So on the left, you saw Tim's monthly presentation of the change in the under 11 Class 8 tractor fleet, and you can see it rose by about 6% in 2018 and another 7% in 2019. So we've added an awful lot of trucks. On the other side, we've got net freight. So this is a combination of two models we run. The first is our freight composite, which is a freight-weighted look at GDP. So we take the subcomponents of GDP and we've weighted them. As someone said at our last conference, there's no freight in a haircut. So I'm still creating economic activity, but I suppose there's some rubbish at the end. But there's not a lot of freight in consumer services. But there is a lot of freight when you're building a house or building a car. So we apply appropriate weights to come up with our freight composite. We also have a Class 8 productivity model, and one of the things that as the cost of trucking services have risen, shippers have really gone into overtime to do a better job of getting more widgets per truck and or more widgets per box, I should say, and more boxes per truck. So that's so what we end up with is net freight, which is our freight composite, the percent change in freight composite minus the percent change in productivity. And the situation here is, if I look, in 2000, I get the right cycle here. In 2017 and 2018, because of the electronic logging device mandate, we actually had freight go negative. We also had the Tax Act at the end of 2017. And really goosed, so strong freight growth, negative productivity. So we actually were growing net freight about 4% per year. So where we are this year, we still have decent freight growth at about 2.7%. But after pardon the colloquialism, after shippers got their butts kicked by freight rates in 2018. Everybody went into overtime trying to figure out how to do a better job of getting more widgets per box and more boxes per truck. So we've seen a really strong surge in productivity, and that surge is density, which I've been talking about. The second is utilization, a little bit of modal share, which is actually since intermodal loads are actually contracting right now, trucks are gaining modal share. So anyway, so if anybody needs to leave, that was the highlight of the presentation. So just looking at, this is a deeply cyclical industry, and you can see the long history of Class 8 retail sales here. But if we focus on the text box over here on the right-hand side of the slide, if we look at the four recessions since ACT has been collecting this Class 8 data. You can see, kind of the pre-recession peak volume and the trough volume that usually occurs about 2 years later. And in each of these recessions, if we average it out, I think it's about 54%. So on average, when you have a recession, the North American Class 8 market declines by roughly half. So 345. If we go into a recession, 190,000 units or 170,000 units, 345 divided by 2, that'd be 172,500 units. It would not be an unreasonable expectation. We do believe this is a freight cycle correction. And if we look at historical freight cycle corrections, we typically get mid-20s types of decrements as you have the pause that refreshes in the industrial sector before demand re-engages, you clear capacity. Truckers don't buy as many trucks, it makes it all better. So our current forecast, because we sold so many trucks this year or built so many trucks this year, and we'll touch on that later, we do believe it's about a 30% correction as we head into next year. So just a North American economic recap. The story is basically across the U.S., Canada, and Mexico: healthy consumers and weak manufacturing. The U.S. economy last year grew at 2.9%. Our forecast for this year is 2.3%. The trade war with China is certainly weighing on is a topic that weighs heavily in the meetings that we're having at ACT Research right now. It's not just the trade war between the U.S. and China. And I did think David Teolis yesterday in the little global workshop we had, he pointed out year-to-date 2019, the net change in trade between the U.S. and China. So I think we have sent the Chinese like $225 billion less goods year-to-date than we did a year ago. The Chinese have sent us like $228 billion less goods than they did a year ago. So all of this Sturm und Drang has netted us a $3 billion improvement in our trade balance with China. So and the risk, and I think if you using Brian's line, if you Google U.S. dollar RMB exchange rate and look what's happened to that exchange rate since the beginning of the year, or excuse me, since August 1st, the Chinese took a shot across our bow and said, well, we're just going to deflate our currency by 3%, and year to date that's a 12% currency devaluation. So we're raising tariffs. The Chinese are lowering the value of the RMB. So it does two things. One, in like the country pair, by reducing the value of the RMB, it makes U.S. goods more expensive in China, and it makes Chinese goods less expensive in the United States. But we also saw with this most recent devaluation of the RMB, we saw New Zealand, India, and Indonesia all slash interest rates to help lower the value of their currency, and that's where the risk is there's a race to the bottom as everybody is trying to stay competitive with the 600-pound gorilla that is Chinese manufacturing prowess. Canada started to gain a little traction, but they're a commodity-based economy, and all one has to do is look at commodity prices right now, and we're looking at commodity prices at their lowest level since 2015. Last year, Canada grew 1.9%. This year, around 1.4 is the current forecast. Mexico, if they're not already in recession, it's getting very close. Our forecast is down around 1% right now from 2% last year. Lopez Obrador's austerity policies, he's cut some make-work projects that his predecessors put in. The problem is when you cut those make-work projects, you cut out a lot of work. So he's got it working with a weak peso and certainly trade uncertainty. So this is my, I guess that counted as an economic slide. Here is a good summary of trade wars, and as Tim said, or to reprise Adam Smith and Senior Deputy Governor of the Bank of Canada, Carolyn Wilkins, trade wars are neither good nor easy to win. So 18th century economists and 21st century economists can all agree on this point. So my one freight chart, and we'll have Peggy Dorff from DAT up on the stage before the end of the conference, but this is DAT data that we've been diligently scraping off of DAT's website on a monthly basis for about the past 10 years. So the pink lines here, or the red and pink line, is spot freight rates. The blue line is contract freight rates. The green area at the bottom is the spread between the spot and contract rates. And if we look historically, the median rate gap between spot and contract rates is about 17%. At the end of July, the seasonally adjusted rate gap was 36 cents. So in order to bring the market, the contract rate back into balance with the spot market, we need to see a decrement of about 19 cents, or about 10% of the contract rate as it stands today. Conversely, we could see some rise in the spot rate as well, but Tim has assured us that's not going to happen until about next June. So it's not an ideal situation as we look at these things. The next place we're going to look is the U.S. Class 8 dashboard that Jim Mosley and me partially created at the beginning of 2016. As many of you may be aware or may occasionally remind us, we were late on our call for the downturn into 2016. We could have probably been 2 or 3 months ahead of when we said, holy cow, this is going to be much worse than we're currently forecasting. We look and it's like, oh yeah, the data's, there were enough disparate data points that we're saying, yeah, this is happening, but looking at all these disparate data points in isolation, we weren't able to just drill down on it. So Jim and I worked together and we came up with a list of 15 metrics, 5 economic or macro metrics, 5 freight related metrics, and another tip of the hat to DAT for some of the work there, as well as the ATA, and then 5 industry specific, or as we like to call them, ACT metrics. And I will say we have seen excellent trend identification in the current cycle. So this is the dashboard, and you can see all the detail, and I'll let you read over this in your own time. But what I really want to do is take you up to the top line, which is the green minus red tally. So we don't weight any of the 15 indicators more than any other. So the way it works is we have a range of expectations for each indicator. So it's either below the range of expectations, within the range, or above the range. And so if it's below, it's a -1. If it's above, it's a +1. If it's within the range, it's a 0. So what we do is the green boxes on this chart are the +1s, the red boxes are -1s, and we add it up on this top line. And you can see back starting in the third quarter of 2018, we were really seeing a slowdown in the green minus red tally of these 15 variables, going to neutral into the end of the third quarter. And then by the beginning of the fourth quarter, we started getting negative readings, and in the most recent months, high single digit, low double-digit readings, and we've only had 1 or 2 other -11 readings. So this is about as bad as it comes. And you can see, where the weakness is most prominent is in the freight metrics, and then in the industry-related data. And I would say the change from -11 to -9 comes down to one data point. The Dow Jones Truck Stock Index did have a nice run-up in the month of June, so we had a 2-point swing just on that one variable. If I look at this, over the previous 13 months, so the last chart was June of 18 through June of 19. This is May of 17 to May of 18. And just quickly, you can see, I'm not a master of the technology. You can see that we were moving along in kind of 4 or 5, which suggests that kind of trend level demand. So for the North American Class 8 market, think 270,000 unit market, and then starting in October or November, we start getting the 7, 8, 9, 10, and we jumped on our forecast, right in October of 2017, and said that 2018 is going to be a much bigger year than we're currently forecasting. So this has provided some dividends. So if we graph this, so the bars on this graph are the dashboard readings, and we've overlaid this. The black line is the U.S. Class 8 tractor net orders on a seasonally adjusted and 3-month moving average basis. So it's pretty specific. But what turns out interesting is, and Sam will say, you can torture data enough with Y1 and Y2 axes to make anything fit together. And so I was able to torture the data enough, and surprisingly, we actually, it was kind of unintentional that we were building an actual volume predictor. And the dashboard does have a 4-month lead on it. I apologize for that. But the dashboard and the volumes of tractor orders are, you say, yeah, that works pretty well. So interesting aside there. When we think about Class 8 demand, and obviously, it's not just me. We've got a lot of analysts, starting with Steve, and then Jim, and then Tim, and there's a lot of inputs, and Sam is grinding away on the economics, and we've got great support with Jennifer and Brian and Margie, and none of us could do our jobs if it wasn't for Debbie, keeping everyone marching in a straight line. So there's a lot that goes into it besides just these things. But when we think of Class 8 demand, it's underlying replacement demand. So how many trucks are going to die every year, or as we like to say, in rust we trust. And then new demand, so if the economy grows, it generates more freight. So how many trucks do I need to generate the additional freight that's been created on this year? And then, as we talked about productivity, what is the impact of doing work better? And then finally, and Tim showed in some of his slides, regulations and other exogenous factors can impact, have significant impact in the timing of the market.